Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called the Fulcrum Pivot Reversal Hedge. This is a pure price action strategy, which means there are no traditional indicators here at all. Instead, it builds a rolling pivot level from recent price, watches for engulfing candle patterns at the edges of that pivot, and even includes a built-in hedging routine for when the market keeps pushing the other way. By the end of this video, you'll understand exactly how it reads the chart, how it enters and exits, and how that hedge works. Let's get started. So what exactly is the Fulcrum Pivot Reversal Hedge, and what is it trying to do? At its heart, this is a price action reversal strategy. That means it doesn't rely on moving averages, oscillators, or any traditional indicator. Instead, it reads the raw candles on a single chart and a single time frame, the same time frame you attach it to. The central idea is the fulcrum. On every newly completed bar, the strategy looks back over a window of recent candles, by default the last 20, and finds the highest high and the lowest low in that window. From those, it calculates a classic floor pivot, a central pivot point, an upper edge it calls R1, and a lower edge it calls S1. Think of the central pivot as the balance point, the fulcrum, and R1 and S1 as the upper and lower edges where price tends to stretch and then snap back. The strategy then waits for a specific candlestick pattern, an engulfing candle, to form right at one of those edges. A bullish engulfing at the lower edge signals a possible reversal upward, and a bearish engulfing at the upper edge signals a possible reversal downward. The stop loss and take profit are read directly from that signal candle's own range, so each trade is sized by the market's own structure rather than a fixed distance. Finally, there's the hedge. If a trade drifts against the position far enough, the strategy treats it as a possible breakout straight through the pivot and opens an opposite side hedge to take part in that move. Who is this style of strategy for, in an educational sense? It's aimed at traders who are curious about combining classic pivot levels with candlestick patterns and rule-based position management. As always, this is for learning only, and trading carries real risk of loss. Let's walk through the mechanics step by step, exactly as the code describes them. The strategy works on completed bars, so it acts once each time a new bar opens, which confirms the previous bar has closed. It also needs enough history, the look-back window plus a few extra candles, before it does anything. First, the pivot. The strategy scans the look-back window, by default 20 completed bars, and records the highest high and the lowest low. It then computes the central pivot as the high, plus the low, plus the last close, all divided by 3. The upper edge, R1, is 2 times the pivot minus the low. The lower edge, S1, is 2 times the pivot minus the high. These 3 levels are recalculated on every new bar, so the fulcrum rolls along with the market. Next, the pattern. The strategy inspects the 2 most recently completed candles. For a bullish engulfing, the older candle must be bearish and the newer candle bullish, with the newer candle's body fully covering the older one's body. For a bearish engulfing, it's the mirror image. Now the entries. For a long, the strategy requires a bullish engulfing whose low dipped to or below the lower edge S1, but whose close finished back above it, a probe and reclaim. When that lines up, it signals a buy at the ask. The stop loss is placed just below the signal candle's low, with a small buffer set as a fraction of that candle's range. The take profit is the entry plus the reward ratio, by default 1.5, multiplied by the risk distance. The short is the exact mirror. The strategy requires a bearish engulfing whose high reached the upper edge, R1, but whose close finished back below it. It then signals a sell at the bid, places the stop just above the signal candle's high, and sets the take profit at the entry minus the reward ratio times the risk. Only one of these reversal trades is allowed at a time. That's where the hedge comes in. On every tick, the strategy measures how far the open trade has drifted against its entry. If that adverse move reaches the hedge trigger fraction of the original risk, by default 60%, without the stop being hit, the strategy reads it as a likely breakout through the pivot. It then opens an opposite side hedge using a separate magic number, sized by the hedge volume factor. The hedge's stop sits back at the original entry, and its take profit extends 2 times the risk in the breakout direction. So a genuine recovery costs the hedge little, while a real breakout lets it work. Let's look at the actual MetaTrader 5 code on screen, the way you'd see it in MetaEditor. At the top are the inputs, the settings you can adjust. PivotLookback, default 20, sets how many completed bars define the pivot window. Stop buffer factor, default 0.25, adds a cushion to the stop as a fraction of the signal candle's range. Reward ratio, default 1.5, sets the take profit as a multiple of the trade's risk. HedgeTriggerR, default 0.6, decides how far a trade must drift before the hedge opens. Hedge volume factor scales the hedge size. Lots sets the base volume, and Magic identifies the trades. Now the long block. The condition reads, if bull engulf, and the signal candle's low is at or below S1, and its close is above S1. When all three are true, the entry is taken at the ask, the stop loss is the candle low minus the buffer, and provided the risk is positive, the take profit is the entry plus the reward ratio times that risk. The open trade call with true sends the buy. The short block is the mirror. If bear engulf, and the signal candle's high is at or above R1, and its close is below R1, the entry is taken at the bid. The stop is the candle high plus the buffer, and the take profit is the entry minus the reward ratio times the risk. The open trade call with false sends the sell. Notice both sides read their stop and their target straight from the candle, not from any indicator. Now let's bring it all together on the chart and walk through both a long and a short trade, candle by candle. On screen, you can see three dashed horizontal lines marking the rolling fulcrum. The gold line in the middle is the fulcrum pivot at 1.0865. The green line below is the lower fulcrum edge S1 at 1.0835, and the red line above is the upper fulcrum edge R1 at 1.0895. Between those edges is where the strategy expects price to balance and then snap back. We begin near the fulcrum. The first two candles drift lower, sliding away from the pivot and down toward the lower edge. This is exactly the kind of approach the strategy is waiting for, price stretching down toward the green line at 1.0835. The third candle is a firm bearish candle that pushes right into that lower edge. On its own, that looks like sellers are in control. Then comes the key candle. The very next candle opens lower and actually dips its low beneath the lower edge, briefly trading below the green line. But by the close, buyers have stepped in, and the candle finishes well above the lower edge, completely covering the body of the previous bearish candle. That is a bullish engulfing that probed below S1 and reclaimed it, the exact long condition. You can see the buy entry marker print at the close of that candle. The stop loss sits just beneath that candle's low, below the green line, and the take profit is projected upward at 1.5 times that risk. From there, price does what the strategy anticipated. The following candles rally back up through the fulcrum, climbing away from the lower edge and toward the middle of the range and beyond. Price reaches the take profit marker, and the long trade is complete. Notice the move ran from a probe of the lower edge back up through the gold fulcrum line, a textbook reversal back toward balance. Now watch the mirror image set up on the other side. After the long closes, price keeps pushing higher, and the next candle drives up toward the upper edge, the red line at 1.0895. That candle is strongly bullish, and it looks like a breakout could be brewing. But the following candle tells a different story. It spikes its high above the upper edge, poking through the red line, and then reverses to close back below it, engulfing the body of the prior bullish candle. That is a bearish engulfing that probed above R1 and was rejected, the exact short condition. The sell entry marker prints at the close of that candle. The stop loss sits just above that candle's high, above the red line, and the take profit is projected downward at 1.5 times the risk. Price then rolls over. The next candles fall back through the fulcrum, away from the upper edge and down toward the middle of the range, until price reaches the take profit marker and the short trade is complete. Once again, the move traveled from a probe of an edge back toward the fulcrum. So in both cases, the logic is the same. Price stretches to an edge, prints an engulfing reversal that reclaims or rejects that edge, and the strategy trades back toward the fulcrum, with its stop just beyond the signal candle and its target set as a reward multiple of the candle's own risk. And remember, in a live market, price doesn't always snap back. Sometimes it breaks straight through the edge, and that's precisely the situation the hedge routine is designed to address. This illustration is simplified for teaching, and real charts will rarely be this clean. And that brings us to the end of our educational walkthrough of the Fulcrum Pivot Reversal Hedge. We covered how it builds a rolling floor pivot from recent price, how it watches for bullish and bearish engulfing patterns at the lower and upper edges, how it reads its stops and targets from the signal candle itself, and how the hedge responds when price breaks through the pivot instead of reversing. Remember, everything here is educational information only. It is not financial advice, a recommendation, or a solicitation to trade, and trading always involves real risk of loss. If you found this helpful, please like the video, leave a comment with the strategy you'd like analyzed next, and subscribe for more MT5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.